Hello everybody. Welcome back to Strongman Personal Finance. My name is Christopher Bell. I'm a certified public accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And I'm not a big fan of PayPal stock. Why, you may ask? Because of Elon Musk. No, I'm just kidding. So, PayPal is a pretty popular payments processor, okay? I've actually started using it myself. It's pretty convenient. You go on there, you can send money to people, you can generate invoices if you have a business, you can send money back and forth super quickly and securely. It's pretty freaking nice, okay? I like PayPal, and I think it's a great business. But that doesn't mean that you should buy the stock. Now, here's a picture of some of the founders. We got Peter Thiel, Mr. Frickin', what's his face? What's that popular stock everybody seems to love that's massively unprofitable? Palantir. I think he's involved with Palantir. And you got Elon Musk, who, this was Elon way back in the day. He looks like he was balding back then. Did he, add some Rogaine? I don't know what he did, but he did not look good back in the day. Now, there's a couple reasons why I don't like PayPal. Number one, if you look at the stock chart, and I'm not a technical trader, but this is one of those stocks that it seems has just benefited massively from the pandemic, okay? Any stock that has just massively increased right at the start of the pandemic is a little scary to me, okay? Because what that tells me is it's probably going to revert back to its normal growth pattern once any benefits it got from the pandemic start to ease away. So as you can see, over the pandemic, so roughly right before the pandemic, the stock was trading at about $122. And then it briefly crashed down to $91. And then it shot up all the way to $308 freaking dollars per share. Now, everybody's talking about PayPal recently because look what happened. This freaking stock has come down like what? Does this actually work? It's gone down to $183, from that high of almost $308. That's a pretty massive freaking drop, okay? So PayPal has been getting freaking annihilated recently. Now, some of the positives that I like about PayPal is it's profitable. They actually have positive net income. They have a PE ratio. They have a pretty decent profit margin at 20%, and they even have a nice gross profit. Surprisingly, I thought that would be higher for PayPal, 46%. They even have free cash flow, and they don't pay a dividend. I don't like dividends because they're tax inefficient, and I'd rather the company either buy back shares so they don't have to pay tax, or I don't have to pay taxes, or the company reinvest the dividends or reinvest the retained earnings, the profits of the company, into better ventures to create more value. I hate dividends. It's like an involuntary sale of the stock, basically. In addition, it has pretty high return on invested capital. Last year, 15%. Average over the last 5 years, 12%. It's pretty freaking good, okay? Now, what are some of the downsides? You may think, strongman, the stock went down. It had this massive run up, but then it crashed. So if you buy the dip, stocks always go up, so you should buy the dip right now. Now, it's highly possible that this stock is going to rocket back up the day after I make this freaking video, okay? But that doesn't mean it's a good value because I like projecting future cash flows, future earnings, discounting them at my required rate of return, which for me is 15%, and that tells you whether I think the stock's a good deal right now. So, let's go to my trusty dusty tool, which I basically just fleeced off everything money. And I'm not selling this to you, and I'm not giving this to you, so don't freaking ask. But I made a stock analyzer tool that's very similar to Everything Money's. But it's even cooler because it has Meat Spin Kevin, Jeremy LaFufu hanging off the ceiling like a bat, Stink Blow, also known as Stock Mo, George Spaz Lopez, or whatever his name is, and then the Dogecoin Douchenaire. So, here are some of my assumptions. And you may be like, strong man, that's freaking crazy. PayPal has had some crazy revenue growth over the last couple of years. Going forward, as this company matures, its growth rate over the next 5 years, that's what this model looks at, over the next 5 years is going to slow down, okay? It's not going to be 20, 25, 30% going freaking forward. Especially when you consider that there's massive competition, okay? The payments processing industry is highly competitive. Look at these top alternatives. Square, Shopify, Payline, TransferWise, Skrill. I mean, some of these I haven't heard of. Google Pay, I've heard of that. I mean, wow. I mean, there's tons of freaking alternatives to PayPal. PayPal's basically the old dinosaur that is still, you know, young and fit, but there's a lot of youngsters coming up in the world that are causing problems. Now, before we get into the numbers, if you don't know what PayPal does besides PayPal, they have PayPal Credit, Braintree, Venmo. I use Venmo sometimes. Zoom, Zettel, Hyperwallet, and products and services. Okay, so I mean, I basically know about the PayPal, you know, the actual payment processor, and I occasionally use Venmo, but I mean, the other crap I haven't really used, but that doesn't really matter because we're looking at the numbers. So, here are my assumptions for growth for the next 3 years. 12%, 15%, and 18%. Now, let's go look at the past and see how quickly this company has grown over time. So, starting in 2014, revenue grew 18%, 19%, and this is going year to year, 15%, 17%, 20%, 18%, 15%, and then they recently had a massive spike because of the virus. But going forward, no, I think these numbers are going to be a little bit lower. So being generous, I said low of 12, middle of 15, and high of 18. And growth rates may actually be slower. I may be too aggressive even with these revenue growth rates, especially with the competition. Share change, so I actually made it 0 because I was comparing it to Everything Monies to see if I was on the money, and I was very, very close to their numbers. But if you look at their share change, they've issued shares in the past, and they've done buybacks, 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 buybacks. So basically, they're slowly buying back shares. So if you want to be nice, let's say worst case, they somehow issue shares. I don't freaking know. I mean, I don't think that's going to happen, but, you know, you want to be... You'd better really be safe than sorry, you know what I'm saying? So 0.5%, 0%, and then 0.001%. Or, sorry, 0.01%. I don't know why that does that. It's so freaking annoying. Actually, let's do 0.5%. So, I said, worst case, they issue a little bit of shares, or they don't issue any shares, or they buy back some shares in the high assumption. Okay? I mean, you can change that if you want. I mean, maybe they'll keep buying them back. You know, maybe the high assumption can be, you know, -1. And then the middle assumption can be, you know, a little bit of buybacks. And the low could be 0. It's whatever you want to do, okay? Profit margin, 13, 14, 15%. Let's go look at their profit margin. So we go over here, net income ratio. Let's go look at the past. 13, 14, 5, 13, 12, 13, 13, 13. So it's been roughly around 13. So maybe let's do 12, 13, and 14%, all right? Free cash flow as a percentage of revenues. Free cash flow, 18, 23, 21, 19, 22, 14, 30, 21, 20. It seems like it ranges, you know, in between high teens and the 20s with a couple flukes going into the 30s. So, for free cash flow, I'd say 20, 22, and 24 are pretty reasonable. PE. In the future, this company will still be growing faster than, you know, some other companies I've reviewed, but it's still going to have a much lower price to earnings ratio, in my humble opinion. I think low case 12, high case 18. You can modify that. I mean, you can do, you know, 15, 20, and 25. I mean, we can look at that and see what it does, but even then, I still think the stock is overvalued. 15, 20, 25. So, 15% return, 15, 15, 15. So here's what I get, ladies and gentlemen. Here's what I get. These are my buy points to get a 15% return. The only way this is even close to being a buy is if you're looking at free cash flow and you believe all these assumptions are going to happen. So it's going to be revenue growth of 18% every year, compounded for the next 5 years, 18, 18, 18, 18. 1% buybacks, 14% profit margin, 24% free cash flow, and then PE of 25. I mean, it's possible. It's possible. I'm not going to say it's out of the realm of possibility, but I don't know. Now, if you wanted to get a 10% return, okay, the stock is still kind of in between, you know, because you compare multiple of earnings. This is based on net profit, and then you have discounted cash flow, which is based on free cash flow. It's in between the two numbers. I still think it's pretty massively overvalued because if you look at the middle assumptions, I mean, you're between $85 and $144. That, to me, that's just, the stock needs to drop a lot to really get within my comfort zone. And I think the PE is going to be lower. So I would say, for me personally, you know, 15, 15, 15. Less than $100, maybe 90. 90 bucks. It needs to get cut in half, basically, before I would consider buying this stock. I know it sounds crazy, but I don't know. I mean, you go back and look, and before the pandemic, before this craziness, let's see. It was trading at, yeah, in the low hundreds, okay? And then it dropped to, what, 85? So basically down here when the pandemic first started and the stock market crashed. It probably would have been potentially a buy right there to get a 15% return. But now, even with this huge freaking dip, this stock is not a buy, okay? But you do whatever you want, okay? You buy the stock and then it goes up and you just think you're a genius because you bought the dip. When in reality, you're just, participating in a freaking bubble. So that's my thoughts. Highly competitive industry out there. Massive run-up since the pandemic, Looking at the numbers themselves, the numbers just don't work for me. I don't like it. But, you can do your own thing. You do whatever you want, ladies and gentlemen. Anyway, that's it. Like, subscribe, tell your friends about me. Buy my book, Stop Being a Broke Loser. It's on Amazon. And y'all have a wonderful day. Cheers!